You want to know what are the best stocks to buy right now? I've got 5 stocks that I think are attractive right here, right now. Let's go. First, there's 7 things that you need to know. This week has been absolutely crazy. Opendoor up 60% today. It named a former Shopify executive as the new CEO. Larry Ellison briefly became the world's richest person, dethroning Elon Musk yesterday, just to lose that almost immediately back to Elon. Oracle stock ripped 36% in a single session yesterday, which added an eye-watering $240 billion in market cap. That's like adding the entire company of Nike and CrowdStrike, while having $20 billion left over to buy Wingstop and Celsius. All 4 of those companies combined would equate to that market move yesterday. Inflation data, PPI, wholesale, a little bit lighter than expected yesterday. CPI came in slightly hot today. The job market is not looking good. Check out those revisions. And the Fed likely cuts rates this coming Wednesday, September 17th. Of course, this could move markets because you have Jerome Powell doing a press conference at 2:30 p.m. Eastern. First, let's talk about Trade Desk. A double whammy yesterday. 2 different things happened almost simultaneously. The first thing that happened is Morgan Stanley moved to the sidelines on Trade Desk on mounting concerns over growth and cut the price target from $80 to $50. The 12-month price target is $50 for Morgan Stanley. Now, with that said, there are plenty of analysts that are still bullish on the stock. And of course, you don't buy or sell just because Wall Street analysts say it's a buy or sell or have a price target of this or that. But you can see a revision down on a lot of these from 105 to 80, from $100 to 50, from 83 to 60, and so on. So when you look at this category, the prior price target, that's going to be higher than most of the current price targets. With that said, you do see 110 here, $100, $105. If I'm buying it at 55, that's 100% upside. The problem is the analysts are very mixed. And furthermore, the sentiment is very bad. It's basically next to zero. Not many people want to buy the stock. The second thing that happened yesterday, and this really was the coup de grace, Trade Desk stock falls after Amazon Netflix ad partnership. Now, I do think that this is misunderstood, and I'm going to tell you why. First, a little bit of edification on Trade Desk in case you don't know what it does. The company aligns agencies with their brands. Now, this side is advertiser, this is publisher. So Trade Desk is going to be on the buy side, advertiser side, and that's what's known as a DSP. Now, this is important, so pay attention to this part. You'll see Amazon also listed as a DSP, but it functions as a walled garden. What does that mean exactly? A walled garden is a closed digital advertising ecosystem like Amazon, where the platform owner controls user data, advertising tools, and measurement within its own environment. So even though it's an Amazon DSP, demand side platform, it's a walled garden. The Trade Desk, on the other hand, is also a DSP, demand side platform, but it's independent. It focuses on open internet and offering cross-device targeting, advanced reporting, and media neutrality. Now, if you're a person that wants to support the open internet, you're going to be a fan of Trade Desk. Why would advertisers want to choose Amazon? Because it's easy. Seamless integration within the ecosystem, but you would use Trade Desk for more comprehensive cross-channel insights and flexibility across a wider variety of publishers and apps. Now, on one hand, I'll admit that this is a risk for Trade Desk. Disruption is happening in this space. So we called, Trade Desk best of breed, and that's been true, but the story is changing and disruption is happening, and you have to be aware. The main thing you have to understand here is that Netflix is not getting rid of Trade Desk. Yes, Amazon is coming into that ecosystem, which provides more competition, but the Trade Desk is still a partner of Netflix. And Amazon doesn't replace Trade Desk not only at Netflix, but within the ecosystem itself. Neutrality that Trade Desk offers is really going to complement Amazon's walled garden approach rather than completely directly replacing it or making it a full substitute. Advertisers are going to use both in many cases to diversify their strategies. Now, I've been around the block. I've been investing 30 years, and I'm not naive. I'm not saying that competition from someone like Amazon is a good thing. I'm not saying it's a good thing. The Amazon effect is real, and Amazon is absolutely crushing it with digital advertising. Now, if you watch my top 10 high conviction stocks to own for the next decade, Amazon is number one on that list, and Trade Desk is nowhere to be seen on that list. So obviously, if you're going to buy one company, it's Amazon, but not necessarily just for ads. That's just one tentacle within the octopus. The Trade Desk is still a major player, and I think at these prices, it gets attractive. But I would treat it more as a speculative type play because of the disruption that's happening in this sector. The Trade Desk has a profitability grade on Seeking Alpha of an A-, very strong profit margin, 79%. Now, this is a unique model that falls more in that recurring revenue, so you would use those SaaS, software as a service type names for comps. And I'll get to those in a second, but I want to show you the growth here. 23%, 19%, very solid growth. The valuation, you could look at something like a forward GAAP P ratio and say 55.77 is really expensive, but you have a lot of recurring revenues with these contracts. Price to sales forward 7.88, which is expensive, but compared to a lot of stocks that we just looked at in chart day a couple days ago, we're seeing some insane valuations right now, 150 price to sales and so on. I'm not saying that that justifies paying 7.8, but anything with growth right now has a premium. And remember, if it has recurring revenue, it's also going to carry a higher premium. So this stock is down 55% in the past year. It's down 61% year to date. So is this a bottom feeder? Is it a value play or a value trap? Well, Wall Street and Seeking Alpha analysts both have buy ratings. The quant has a sell. And you probably know from experience that oftentimes when you see buy, and sell, it's actually a good time to buy. So if you look at those cloud SaaS metrics for Trade Desk, the EV/NTM revenue is an 8x, which isn't dirt cheap, but compared to its peers, is pretty attractive for the growth, especially when you look at the Rule of 40. That Rule of 40 is a 53%. That's NTM. The NTM free cash flow margin is 28%, which is solid. The main problem with this, the red flag, is the net dollar retention is 95%. Now, of course, you want that to be over 100%. This essentially is telling you that it's losing customers, and this supports the fact that it's being disrupted. Because of that, I think the stock could have more pressure, and I'm going to show you a chart and tell you where I think it could go. I made a video recently, and I told you I like Trade Desk, $50 or less DCA. Wait for $50. And I told you it was going to get there. Of course, it's there now. It's at $45.64. The April lows was $42.96. I think there's a good chance you go and retest those. You could even break those. The S2 Fibonacci is below 40 at $39.95. And this S3, which is doubtful, but it could happen, is $24.20. So I do think there's a chance that this could break $40 a share. If you're in our Discord, you already saw this yesterday. If you're not in our Discord, consider joining us. But I said I think it could end up under $40 with time. This is yesterday around the same time as I'm making this video. And it could have saved you a few dollars a share by waiting because I told you it was probably going to go lower. I told the gang to be patient and that the Trade Desk is not a back the truck up, not yet anyways. Now, I did buy 10 shares in the community portfolio. I just want to communicate with you guys. Sentiment could make this go lower, especially with headlines or anything like that. So I do think that $45 is an area that you can buy on Trade Desk, but you have to understand that it can go lower. I think longer term, if I zoom the lens out, maybe 12 months to 18 months, I do think this will be $100 plus per share. Now, I could be wrong, and that's why I'm going to treat this as spec. Try to keep it a small position in your portfolio, generally 1% or less. All right, let's switch gears from digital advertising to cybersecurity. And this is in Discord under Investing Trade Floor. And I'm seeing quite a few buys here for RBRK. This is Rubrik. And you can see the stock is down about 3% today. And if you look at the last 5 days, we're down close to 12%. You can see that Rubrik reported earnings here a couple days ago. It was a beat on the top and bottom lines with strong revenue growth here, 51.2% year over year. Headline, Rubrik falls on strong Q2 performance as value appears mostly priced in. We do see Goldman Sachs here actually increasing the price target to 120 from 117. KeyBank also raised price target from 114 to 117. Again, this is trading at $78 a share right now. Piper Sandler retained its overweight rating, $115 price target. Here they're calling it a Gen Z architecture. Mizuho maintained neutral rating and $97 price target. Overall, the earnings call was pretty good. Management reiterated its confidence confidence in the company's ability to deliver continued top-line growth, as well as profitability improvements. This is an expensive stock. I'll cover the metrics here in a second. They did mention AI integration as a key differentiator several times on the call. Remember, this is a fairly new IPO, so we don't have a lot of data on the company. It does have 6.68% short interest, around a $15.6 billion market cap right now. This is going to be another SaaS company, software as a service. We got A+ here, profitability on Seeking Alpha. I don't necessarily agree with that, but I do like the gross profit margins with that recurring revenue around 78%. Very strong revenue growth, 47%, 34.73%. Valuation, not going to be profitable. So price to sales, it's going to be expensive. We just talked about it on Trade Desk. This one's 12.66. So let's look at those cloud SaaS metrics. EV/NTM revenue, a 13x. That's quite a bit more expensive. Trade Desk was 8x, but this company is growing. It also has 120% net dollar retention, and that rule of 40 NTM is a 51%. Now, one thing I didn't draw attention to much on Trade Desk is that rule of 40 is actually 53%. So an 8x on 53%, that's why I think it's attractive at this $45 level. Also with Trade Desk, you have 28% free cash flow margin versus only 7% on Rubrik. Rubrik is a much younger company and it has a higher growth trajectory. You could also say that Rubrik is more of a disruptor where Trade Desk is getting somewhat disrupted. That, of course, will affect the valuation and the premium that investors are willing to pay for it. And yes, I understand these are very different businesses. I'm not trying to compare apples to apples. Looking at a chart, you can see brand new listing, IPO, April 2024, $28, rips all the way to 103, drops to $47 here in April. Pretty much anything you bought in April, you did pretty well on it. The stock is trading currently around this S2 Fibonacci. The S3 Fibonacci is $72.95. I told the gang in Discord under Eric's watch list that Rubrik is probably a buy, $75 or less, which might not happen, but the S3 again is $72.95. So just 1 week ago, I did a top 3 stocks to buy, and I told you that one of the stocks on the list you could buy and get a better cost basis at that price that day than what I had. I was down 5%. Now I'm up like 6% on this stock, but I still think it's a buy. Any guesses? Gitlab. It's popped about 10% in the last 5 trading days. You know the story on this one. I've covered it several times. 88% gross profit margins. We really need to look at those cloud SaaS metrics, and I'll get to those in 1 second. Revenue growth here, A+ on Seeking Alpha, 25%. Valuation, another software as a service company, SaaS company, so it's not going to have that PE ratio. Price to sales forward on this one, 8.67. So looking at those cloud SaaS metrics, EV/NTM revenue on Gitlab is a 6.8x, which I believe is attractive. 17%. This is next 12 months free cash flow margin. The next 12 months rule of 40 projection is 46%. Again, anything over 40 is a solid number. And this net dollar retention is very strong. 121%. And this is telling you that customers are not only staying with the platform, they're spending more money with the company as well. Now, of course, I preferred the stock lower, $45 or less DCA with a preference below $40. You can see it got in the 37, 38 range. The first time was in April and then closer to 39 here just a couple weeks ago. And the stock has really ripped from 39 to 49. You say, well, why would you still want to buy it here? This R3 upside's 57. And you can see we had a double top around 75 here. I'll say it again. It's never a reason to buy or sell a stock because of an analyst price target. But Guggenheim just started this as a buy with a $70 price target. That's something like a 40% upside from here. And based on my own projections, I think Gitlab is a $75 stock over the next 12 months. So even though you missed this run from here, I think there's potential to get up here. My preference is still going to be $45 or less DCA, but if you get it at 49, I still think there's upside. Understand that it might not be a straight line. It might go back to 45 or even less, and you would dollar cost average those prices. In order to do that, you have to have conviction. So make sure you watch some previous videos where I go into deeper dives on what this company is all about and why I'm bullish on it. All right, next, guys, I'm going to give you a 3-for-1 rapid fire. So you're going to get a total of 6 stocks. I've already covered 3. I'm going to cover 2 more that the community are buying and they think they're attractive at these prices. And then 1 stock that I'm buying myself for my dividend portfolio. The first one's Chipotle. Ticker is CMG. Now, if you don't know this, I own part of a restaurant, right? So I typically don't buy a lot of restaurant stocks. I do have some Wingstop, do have some Texas Roadhouse. I like this company, but I'm not looking to add any more restaurant stocks at this time. Now, profitability, you look at this and say 40%. If you're used to the tech world, that seems low, but it's pretty darn good actually for a restaurant. Now, with that said, understand these are lower margin type businesses. So net income per employee, you have a lot of employees, you're making less than $12,000 versus a lot of these tech companies are making millions of dollars per employee. The growth, it's really kind of in between growth and mature growth, I guess. Valuation wise, it's not dirt cheap. 32 gap forward P ratio. It's about a $52 billion market cap. The good thing here, I think, is that short interest is only 1.6%. So people aren't really betting against it at these prices. It is down about 29% in the past year, down 36% year to date. So I think the people that are buying it think that, hey, it's beat down. It might be an opportunity. Now, of course, there are fundamental reasons for the stock being down. We're not going to spend a lot of time covering that right now. And when you buy a stock, 99% should be fundamental analysis. The last 1% is the chart. So assuming you do that homework and you like the company and it fits your blueprint, the next thing you do is you come in here and you look at the chart as that last piece. And this S3 Fibonacci, 39.44, it broke through that. Now the previous S3 Fibonacci is down here at 32.45. And for me, I think it gets really interesting, 35 or less, but more than likely it's not going to get there. In fact, buyers are coming in right at these levels now. So more than likely, you're going to be dollar cost averaging below $40 on CMG. The next one is Samsara. IoT is the ticker. Now, this did beat on the top and bottom lines. You've seen this on a lot of these stocks where they have a double beat. They still sell off guidance and so on. But 30.4% year-over-year growth is solid. It's another software as a service recurring revenue company, so 77% margins. This one has a 12.1x EV/NTM revenue, 12% free cash flow. The NTM rule of 40 is 44%, and that net dollar retention is 105%. Now, I've been adamant about $30 or less DCA, and it just teases it and never gets there. You can see 31.40, 31.68. I've got an order in to buy it, 29.97. It hasn't happened. It's okay. It's a fringe play. It's not a core. I don't have to own it. I missed the rip up. I think there's more upside potential here. You're looking at probably $42, $43. On the upside, though, the stock at one point was $62. I don't think it's going to get to $62 anytime soon. I do think you can see 45, maybe even 50 over the next 12 months. And a lot of members have been buying this stock. And this last one is down 38% in the past year, down 32% year to date. Pays you over a 5% dividend yield, 56 years of dividend growth. I'm buying this in the dividend portfolio. Again, that portfolio is focused on passive income, not on growth. I like this stock really anything $100 or less DCA. If you can get it below 90, of course, even better. I think I have a cost basis around $95, so I'm down something like 5% on this. I think longer term, that target will do fine. And I'm not buying this because I think it's going to double overnight. I'm buying it because it has a solid dividend, and I believe it's a safe dividend, and it fits perfectly in that dividend portfolio. It might not be for every portfolio. If you're a young investor in the accumulation phase, this probably isn't your huckleberry. Thanks for watching, guys. If you're new here, make sure you subscribe to the channel so you don't miss videos like this one. Take care.